You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to our Wednesday catch-up show with Zulfe Ali of Validity Group. This is Buck Joffrey, Wealth Formula Podcast. Zulfe, welcome back to the show.
Thanks, Buck. Great to be back.
We always start with a little bit of a sort of a response or some commentary on the sort of the flagship show of the week, which was this week with Kim Daly, I believe, on franchise. What are your thoughts on that? I mean, obviously you're not a franchise guy, but thoughts in general?
I'm not, but I could be. I mean, in the sense that, you and I have talked about, our personal kind of, abilities to just create stuff out of scratch. You do that. You're an entrepreneur. I'm a guy that likes to have a plan and almost, something that's been tried and tested and kind of implement. So I'm more of an execution guy. And actually, it resonates quite a bit for me, the concept of taking, someone else's plan that they've developed. They've built a few of these, they've implemented them, they've tried them out, they've optimized them. And then, you've got basically you're buying into something that's been road tested a bit. It's obviously still could fail because your specific execution or your location, maybe the franchise concept just goes out of favor or whatever. But I think for certain personality types, it's actually a pretty interesting approach.
Yeah, I think it's definitely interesting. I think I've, obviously you and I actually had looked into some of these things before too. Like even I think there was some swimming lessons and all that. Yeah. And I think for me, like the things that came to mind were that, a lot of times the franchise fees are so high that to me, as somebody who's not ever dealt with the franchise fee, was kind of a big turnoff in the sense that, like, for example, they might be 8 or 9% of gross revenue, right? And like, I mean, that was something that I saw that I was like, wow, 8 or 9% gross revenue ends up being like, oftentimes could be like half of your, what your profit would be. And so that has been traditionally a little bit of a turnoff for me. But I do think that there is something there to the extent that, from a couple of perspectives. One is, if the people who listen to this show, a lot of them are like you, right? They're good students, good executioners. You give them a playbook, you give them a curriculum, they'll learn it, and they will get an A. To me, that's kind of what this is, right? You're sort of given the nuts and bolts, and you're gonna like put it together. And the better you are at that, obviously, it's not all, there's some luck in terms of, whether location or whatever works or not. For this type of audience that I have here, it's an interesting product. If you're not a natural born entrepreneur, and you're a little bit risk averse, this could be a good concept. And, the other thought is and we may revisit this, but the other thing that I like about these kinds of things is they do give you an opportunity potentially to, roll up a bunch of these franchises and then sell. And, at some point that might be something that, maybe you, that you look at through Validity or maybe I look at through Wealth Formula or the same, where we identify opportunities and, roll up a bunch of different franchises over time and then try to sell at a premium. So I think it's something real. I again, my personal take on it right now is like, I'm not right there, but I can see how a lot of people would find it very appealing.
Yeah, so. Definitely. The one way that I thought might be interesting as I'd heard that and kind of even brought it back to a prior podcast that you had brought with, getting your kids involved. I've got, like I said, I've got a kid doing his undergrad business program, and I'm like, it'd be ideal for him as soon as he comes out of school, we do some sort of a franchise, put him to work, do a lot of the grunt work and execution, oversee it. So there could be different ways to go at it where you don't have to dedicate a lot of your own time, but I think you do need to have a close watch on it. It is still, it is still a very, execution focused kind of exercise.
Yeah, and that's the other thing is like anyone who tells you that it's not going to be work, they're just lying to you. It is going to be work, and this is not a truly passive asset. You got to have to pay some attention. Let's shift our attention to the week. What's going on in the economy and the markets?
Well, it's been pretty exciting overall. The Fed right now, as we speak, is in its 2-day FOMC meetings. So they go on Tuesday, Wednesday of this week, with a culmination where the Fed chairman will give his his observations of what was discussed amongst the various members. And so people will be really focused on what he has to say. There's really no expectation that the Fed will announce a rate cut this time, and at the meeting
because of the election.
No, I think they don't. I mean, I think the Fed has already signaled that they don't believe that they have enough data to substantially implement a cut at this point. So they want to see a little bit more kind of supporting data between now and potentially September. So, there is a fair amount of expectations from the market. In fact, I was reading an article that said the market has priced in a rate cut for September in about 88% chance likelihood that the Fed will cut by 25 basis points in September. And then there's another greater than 50% chance, as far as the market is concerned, that there'll be another 25 basis cuts in each of the meetings that take place in November, December. So about 75 basis points of rate cuts expected by the market. Now, market has its expectations. The Fed has its own.
75% basis points by the
75 basis points. Yeah,
but by the end of the year.
By the end of the year, yeah. So given that we're at 5.25, take that down to 4.5 to 4.75 kind of range. So so the direction I think is pretty unanimous. Even the Fed has signaled that the next actions will be rate cuts. I think Chairman Powell has been a little bit reluctant to start those immediately, but I think pretty much everyone's expecting, if not September, then November for sure.
So how's that affected the market?
Well, the market is definitely taking it positively, in the sense that the various publicly traded market have been baking that in. I think the stock markets have had that baked in for a while now, and so the overall markets are relatively flat. If you take out the effect of what's going on with the very, very large names, some people call them Magnificent Seven. It's the likes of NVIDIA, Microsoft, Amazon, those names. Those have been trading down just because they've ramped up so much over the last year that people are taking profits on them. But if you look at the S&P equal weight index, that basically is an index where you've got all the same S&P 500 names, except that it is equal weighted rather than market cap weighted. You'll see that is coming out flat from its peak a couple of weeks ago. Whereas if you compare that to the straight S&P 500, which is impacted significantly by some very concentrated names, that's down about 4% since it peaked about 2 weeks ago. So you can see evidence that there is a rotation. So people are still buying stocks, but they're moving out of some of the names that have had a really, really big run up, and they're redeploying into different sectors outside of technology and smaller size companies, mid to smaller capitalization type companies. So, and that's again evidence in the Russell 2000 as well, which is a index that is made up of 2,000 small to mid cap companies. Again, very much flat if you look at where it was 2 weeks ago when it peaked, pretty much at that same level. And then the impact on the bond markets, you're going to continue.
Let me stop you for just a second. I mean, and just again, I'm I don't have, a lot of exposure to the equity markets, but it is interesting to me that when you look at what you're basically saying is that these companies, these magnificent seven, right? Like NVIDIA, Microsoft, Amazon, and all that, they've had these huge run-ups, presumably because of this, AI stuff. And net, I think what people are looking at is that they're thinking, well, maybe it's time to rebalance a little bit. And that's why when you sort of zoom out and look at the S&P 500, it actually looks like pretty much flat. It didn't look like it actually lost anything because the small companies that are sort of non-tech companies, the money's going in there. Is that right?
Yeah. So specifically, if you look at what's called the equal weighted S&P 500 index, which doesn't, it's not skewed by the market cap effect of the standard S&P 500 index. So yeah, if you equal weight it, you'll see that it's very much flat. And then again, like you said, the other way to look at it is just get out of the S&P 500, look at the Russell 2000, which is the next 2,000 companies below the S&P 500 size, and you'll see that there it's doing just fine. It's still trading very, very close to its all-time high. So it's not being impacted by all those very, very large tech names because those tech names are not in that index.
Yeah. So bonds. Let's talk about bonds. And then before we just a quick review, the thing that personally, I'm interested in, and because it often affects real estate so much, is the 10-year Treasury. Why don't you tell us exactly kind of what is 10-year Treasury like, and maybe you can explain why that 10-year Treasury is important to real estate investors, and then what it indicates about sort of inflation.
So the 10-year Treasury is down about 10 basis points from the last time we spoke about a week ago, and it is currently yielding 4.14%. It's been as high as 4.5% if we go back a couple of months. And what that's really reflecting is increased expectation that the Fed is going to continue or start and then continue its rate cutting exercise. So it's reflecting where the market believes that the rates are going to be headed.
Yeah.
And you can also see that in the 5-year, right? The 5-year is kind of going down the same. Right now it's about 4.0%, compared to about 10 basis points higher about a week ago as well. So all of that means is that despite the fact that the Fed has not changed its Fed rates, Federal Reserve rates, rate of 5.25 to 5.5. That's the guidance that they've stuck at for a while now. Despite the fact that they've done no changes, the market prices in what it believes is going to be happening, and what we see is the market is consistently pricing, lower expectations for the future, and those continue to come down. And so that's what's going on.
Yeah, I mean, I think the point here, though, I think is really important because I've been, sort of beating the drum on this for a while. I mean, rates are coming down, and now the Fed is saying the rates are coming down. Rates are coming down. Look at the Treasury. Look at what's happening with with these meetings. And what we need to, as an investors, this is an interesting time because I feel like I've been sort of, my latest beat on the drum has been, if you're going to buy assets, there's no better time to buy a leveraged asset than when you are in a descending rate environment. And the reason for that, again, is like when you are buying real estate, for example, think about it with your personal house, right? Like you can afford more house at a lower rate. I mean, literally, like people were, in the middle of COVID, people were able to buy houses like twice as expensive as they would have been able to had they were buying them now, right? And so the same thing goes for any investment asset. Okay, so if you're at a high rate and then you're descending, what happens? The asset values start to go back up. In other words, the cap rates start to compress. And so this is just really important. And I know, we've talked about this. I mean, we have, we recently, just released a deal in the investor club. We're not going to talk about it because it's only for accredited investors. But again, it's one of these situations where if you can find an asset that's performing well at the current rate environment, I mean, now's the time to jump, right? Now's the time to look into it because the anticipation of rates are coming down. And then that means effectively you have sort of this, these tailwinds, behind you in terms of helping you towards, ultimately a disposition in a lower rate environment. But any comments on that?
Yeah, no, and remember the the assets that are in the real estate side that are purchased are financed with loans, using SOFR as the rate index, right? And SOFR tracks the Fed rate.
Correct.
And SOFR right now is still 5.3%. So that will come down as the Fed rate comes down. And so what we're seeing is that the markets where the market is in control of rates is saying, no, they're going to come down, and those rates are trading. The yields are trading down. The markets where the Fed is in control or are directly linked to where the Fed is in control, those haven't moved.
In other words,
so what you would expect.
Yeah. In other words, you have an opportunity or a window here where the Fed has already told you what they're going to do, but they haven't done it. SOFR has to basically follow what the Fed rate is. So it hasn't come down. And the treasuries have come down because, well, they work on market forces, right? So that's what I'm getting at is there's this window where if you're locking in something that cash flows now, the current SOFR rate, it's sort of like, the Fed has told you it's going down. It's going down 75 basis points, right? By the end of the year, that's quite a bit, frankly. So again, that's what I think is really important, and hopefully people will start to pay attention to that and look at opportunities if they're interested. So, what else? Gold prices.
Well, yeah, I mean, we usually just go through a couple more. The gold prices still at all-time highs. Again, I continue to be a little confused by what that really means. And then Bitcoin seems like it's come back quite a bit as well. It peaked at around 70K in June, went down to about 58K in early July, and now back up to 65K. I'm guessing you're the expert on this, but I think there's probably a little bump from the whole, Trump support of Bitcoin if he's going to be elected.
Yeah.
Things in there.
Yeah, I think so. I mean, so the idea here is that I think what Trump was saying is that if he's elected, that, there's about $14 billion worth of confiscated Bitcoin that's owned by the Treasury. And, in the past, there's been auctions to sell those off, right? I actually tried to participate in auctions there, but as it turns out, it's you never get a good deal there because you've got huge players who are basically trying to come in and not move the market. And that's the idea. But the bottom line is what he's saying is, we're not going to sell this stuff. We're going to put it into like a national, like a reserve. That, of course, is legitimizing Bitcoin as this, I don't know if it's a commodity or what, so sort of a similar thing with gold. And there's been some movement as well in the Senate. There's been some talk about, trying to, add to Bitcoin, add the Bitcoin treasury. RFK Jr. actually, who, he's not going to win, but, he's got a lot of, he does have a lot of support from people. His, suggestion or his platform is to buy I think it's like 4 million Bitcoin, which is kind of insane actually, because if you think about it, like there will only ever be 21 million Bitcoin. So maybe he just doesn't know enough about Bitcoin. I don't know, but that's a whole lot of Bitcoin to have. Now, I do think that there's something here that, again, you know that I have, you personally know, because I know for years ago, I was telling you to buy Bitcoin, and I think right around when I was telling you to buy it, it was running around $3,000 or $4,000. This is an animal that I just don't think is getting contained anytime soon, right? And it's continuously getting legitimized. And if it does become part of like sort of the, national, I don't know if you want to call it the endowment or whatever you want to call it, or the country starts buying this stuff like other countries are. We talked about Germany potentially selling it last time, remember, and that was a problem. That I think you're going to continue to see the price of this stuff go up. Again, I'm not going to make any recommendations, especially now, because it's not like we're in a time where I think Bitcoin is low. I don't think these are low numbers. I do think that hopefully there'll be a bull market here that runs Bitcoin over 100 grand. But just looking at these numbers and like some of the altcoins and stuff, I think a few weeks ago I mentioned Solana was trading like a 120. I think it's over 140 today. Maybe some of those are more speculative, but Bitcoin is not, in my opinion, even speculative anymore. What is your take on Bitcoin as sort of more of a traditionalist, right? I mean, you've got to be less skeptical about it now than you were when I was telling you about this, I don't know, 5 years ago or 4 years ago.
I mean, listen, I think there is a evolution of Bitcoin to, I think the word you described is to be a more legitimate asset class, right?
Right.
And it's definitely become more institutionalized. The fact that you have ETFs that are now reflecting Bitcoin, the fact that you have a lot of institutional investors and asset managers that are either investing in Bitcoin or including Bitcoin as part of a diversified investment portfolio for some of their clients. To me, all of that is just leading to the fact that it's being accepted as a legitimate asset class. And the question with, investors is always going to be, should we have some exposure? And if so, how much exposure in our portfolio to this particular asset class, just like every other asset class? So from that respect, I mean, I think it's going to continue to, become supported institutionally, and therefore, that demand should continue to increase. And given that it's an asset that has finite supply, right, and is coming to, to a point where it's becoming more and more limited, I think there's something to be said about considering it as part of a portfolio. I mean, certainly, from my own perspective, I wouldn't make it a real material part of my portfolio, but having some exposure could make sense for the right investor, just to have it as as something that could have some potential upside that you want to benefit from in your broader diversified asset classes.
It's pretty easy now too with all these ETFs and all that to do that.
Well, that's the beauty of it, right? I mean, I can buy exposure with an ETF, and I can get in and get out. There's not a lot of friction. I can change my mind and get out very quickly if I want, or if I see technical reasons why I should buy some more, I can quickly buy. So yeah, I agree with you there. That just makes it that much more accessible. And again, that's feeding into why institutions are continuing to look at it as a real bona fide asset class, because there is that liquidity in that market now, and there is that ease of getting in and getting out.
Okay, well, let's move on to another topic. Okay, and that is this economy slowing down?
Yeah, the economy is definitely slowing down, and that's a good thing. So, despite the fact that, we had very, very strong GDP, for the second quarter, GDP came at, 2.8% annualized. That was a bit stronger than anticipated. But, it's expected that we're going to continue to have positive but decelerating growth overall. That's good because it takes the pressure off of inflation, because we were in a situation where that fast growth was causing demand related inflation across a lot of services and products in the US. And so that's great. It also, is still a growth story. So you have support for a strong labor market still, right? Labor, you don't hear about 7%, 8% unemployment rates. We are at just over 4% right now, 4.1%, and that's a good, healthy labor market. And people are still they still have decent balance sheets. They're still spending, but it's not crazy. And so what we have is a decelerating growth. It's not a contraction. We're not in a recession, and that's important. And it's not necessarily expected that we're headed for a recession. There is a pretty good chance, which is described or called sometimes a Goldilocks economy, which is we're going to slow down where inflation is tamed, labor markets remain firm, and then we're going to start building more growth off of that base.
Sort of soft landing.
Soft landing. Yeah. We don't crash into a recession.
So what is
in and out.
So the calculus from the Fed is to make sure that landing is not too hard, and essentially sort of taking the foot off the brakes a little bit, I guess, in terms of, or not, maybe putting the foot, taking your foot off the brakes a little bit, allowing businesses to grow a little bit easier with lower interest rates.
Letting liquidity come back in, and in the form of lower interest rates. So take the Fed rates down, ease up on some of the quantitative tightening that's been going on. So all that kind of stuff that the Fed has the power to do. And it is expected that they are going to take their foot off the brakes a bit, and and hopefully get in a situation where you're kind of at a nice even level, and then you start building more momentum again.
So usually we finish these things out by doing a product or something, just explaining what it is. But I think maybe it would be helpful for people just to understand that if we are in this sort of decelerating economy, what, traditionally should, or no, I mean, not should, but if you look at investments across different asset classes, what has performed well in these kinds of environments?
Well, if you look at what the research shows, and research that has looked across multiple cycles, the asset class that performs really well in this environment is real estate. Real estate, infrastructure is another one, and they're similar in the sense that they are very sensitive to interest rates. Real estate and infrastructure typically have regular cash flow streams, right? And those are also affected by discount rates that you apply. So if you've got a higher interest rate environment, you're going to apply a higher discount rate, and the values of those are going to go down, and vice versa. So real estate has shown outperformance compared to private equity, the private debt markets, even the S&P 500 historically has traded down almost 8 to 10% in this kind of an environment where you have the economy slowing. Because a lot of times what happens is the stock market has rallied significantly before a slowdown starts, and as the slowdown starts and companies' earnings start coming down, their growth doesn't look as attractive, their PE multiples will start to contract. And so you'll start seeing stock prices come down. Fixed income in general does well. So if you have, exposure to bonds, treasuries, that sort of stuff, it does well because rates are coming down, which implies that the price of those bonds are going up. And so you have capital gains on those types of situations. So generally things that are, linked to the interest rate in, kind of a backdrop and that have, consistent cash flow, those types of investments will do well in this.
Well, and then the other thing I think is kind of obvious with real estate is the leverage piece, right? It's the most common of these assets to be leveraged. So if you're in a descending rate environment, again, the value of that asset is going to sort of multiply higher based on that leverage going down. So again, I think it's a good talk about Goldilocks period in time where, like, you have rates have not gone down necessarily, but you've been told they're going down. I mean, that's something that I think people really need to pay attention to, and that's why real estate has performed well in these descending environments. Anyway, I think that's all we got today. If people are in Investor Club, make sure you pay attention to what's in your box, because some of the stuff we talked about today, just really goes directly to the kinds of things that we're looking at in Investor Club, which you will see. But that's it for me today. That's it with Zulfe Ellie. Thanks, Zulfe, for joining me. And we will be back together next Wednesday for another catch-up.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.